Okay, guys, let's do this. This is a forensic chapter. I told the folks who were here last time, oh, it's nice of you to show up. Thanks, we were just talking about how you blow us off all the time. Don't come to class. And you flunked another quiz. Did I give you the other one? The third one? You have to do a third one now. Did I give you the third one? You have to have 75 on this. Okay? You have to have 75 on that quiz or you do not get credit for this class. I'm not even kidding. And if you don't get it on the next one, did I give it to you?
No.
Okay, send me an email and I'll send it to you. Okay? If you don't get 75% on that one, so study first, then do it. Do not look up the answers. That's cheating. Right, guys? Unethical behavior. Right? So you can't do that. So study first. If you don't get 75% right, you're going to outline your chapter for us. You're in the same boat he's in.
No problem.
Who else tried to do this? They're not here today. Okay? Somebody else tried to screw it up too. Right? They only screwed it up twice. You guys have made it 3. Right? You're the third one. And they only screwed up once. That's the second time. Get 75%. Or you have to outline the whole chapter. So I give you credit in class. It's annoying. Okay, so here we go. Let's do this chapter. Tests of details of balances and controls. This wording is so confusing. Details of balances and controls and substantive tests of transactions. What do we mean? Okay. What is a detail of balances? What are we testing? Is the ending balance on the balance sheet or income statement, usually balance sheet, is it correctly stated, right? We have a lot of times for the income statement, we use analytical procedures for a substantive test. But yeah, okay. All right. What is a test of controls, obviously? Are they using the controls? An attributes test, right? Okay. Controls effective or not. What is a test of transactions? Substantive test of transactions. Did the transaction get recorded correctly, right? And that's a yes or no question too, right? Did it get recorded or not, just like the controls are. So the way they're writing this is kind of weird. Which ones go together? The controls and the transactions testing, right? And then the balances are independent of that, right? Usually referred to as substantive testing. Okay, so for controls, it's effectiveness of controls, no kidding. For transactions, it's the monetary correctness of the recording transactions. And for balances, is there a material misstatement? Which one is the one where you really want to be right before you issue a statement? The third one. The balances are critical. Why do we really like controls? Because if we can rely on controls, we can do less work on the balances. Why do we really like transactions? Because if the transactions are recorded well, right, recorded properly, which means the controls are working, right, what's the deal? The balances are probably okay, and we can do less work on the balances. Said that a million times, okay? So, still the same deal. I don't know why they do non-statistical first, but fine, they do. And they're going to compare the two different methods, one for controls and the other one for and test of transactions, and one for doing the balances. And that's fine. But steps parallel to the sampling approach for test of controls or test of transactions, which are the same. There are a few differences because of different objectives. What's the difference in objective? I want to know whether or not the control's working. I want to know whether or not the transaction is recorded properly. Or I want to know is the balance correct. Okay? Different objectives of the test. And the objective of the test is always going to be, for a substantive test of balances, is the balance correct? That's it, right? Is it the right number or not? Okay? So that's pretty easy no matter what account you're working on. All right. Said this was hard. Easy so far. So what do we do? What are the 14 steps? Now, we want to do details of balances. It's state the objectives. I just said what the objective is. Is the balance correct or not? Okay? Decide whether audit sampling applies, whether or not you want to use it. Now, on controls and even on substantive tests of transactions, do you have to do testing? No. What could you do? You can increase the scope of work, right? The size of your samples for the year-end balances. So you can do all your work after year-end, right? This would be what? For a public or non-public company? Non-public. For a public company, you got to test the controls, right? Okay? But you wouldn't have to test the controls at all for non-public if you think you can't rely on them. Correct? You're not going to do an opinion on the controls anyway. We've said that a million times. Okay, so instead of defining attributes and exception conditions, attribute would be what for a test of controls? They follow the control, right? Yes, no. What would be an exception? They don't follow it. It's that simple, okay? What would be an attribute for a test of transactions? They record the transaction right. What would be an exception? They don't. Okay? So it's an either or, right? Attribute sampling. Okay? What would we be over here for the test of the balances? What's a misstatement? What is a misstatement? Okay? All right? And what are we really going to need for that? Instead of tolerable exception rate, what do we need? Or tolerable deviation or exception rate, right? What do we call it over here? Tolerable misstatement. That's it. This is easy so far, huh? Okay, and so, by the way, that's the same if it's statistical or non-statistical, right? Just we're going to add statistics to it, okay? Define the population. The population would be what if I'm doing test of controls or test of transactions? How many times you use the control? That's the population, all the times that you would have used it. There's supposed to be 2 check signers and checks over $10,000. How many checks over $10,000, right? That's it, okay? So how many times would you use it? Or approvals on invoices or something? Sure. Okay, same thing with transactions. How many times you record the transaction, right? All of them that are recorded. That's your population. Your sampling unit would be each one of those transactions or each one of the times they use the control, right? Okay, you select them. What would be the case over here for defining the population? If we're using receivables, which they are in this chapter, but for any account, what would it be? 2 ways we could look at this. What would it be? It could be the ending balance in accounts receivable, which is the total population, that dollar amount, and then what would be the sampling unit inside that? I meant there was 2 sampling units, really. I said it wrong, didn't I? Right? The population is going to be the dollar amount there, right? But what are the 2 ways you can look at it in terms of getting your sample? You can use probability proportional to size, dollar unit sampling, right? Which would be what? With the big ones that have more probability of being selected than the little ones. So what do I make my sampling unit? Each dollar. So if I have $1 million of accounts receivable, each dollar has an equal probability of being selected is the ideal thing, right guys? You guys good? Okay, so that's it. Okay, the dollar, each dollar is my sampling unit. If I have $1 million in receivables, how many sampling units do I have? 1 million. Got it? That's dollar unit sampling, probability proportional to size, mean the same thing. Okay, and then what's the other thing we could do? The accounts, right? You might have some big accounts, you might have some little accounts. Okay, and we could stratify to make sure we get the big ones there. Just say stratify. I don't need to stratify if I use dollar unit sampling, right? It automatically does. I'll select all the big ones over and over and over is what's going to happen, right? And keep going until I have a big enough sample. I match my sample size that I calculated I need. Everybody good with that? Okay, so I can make it each account is my sampling unit. You're going to get questions on that stuff, okay?
Each client or
each customer account, yeah. Or you could make it be each invoice if you want. You want to do it by invoices, okay? But some way to identify, right? Got it? What do we tend to use on assets? Monetary unit sampling, which is also called dollar unit sampling, which is also called probability proportional size. Do I use that? Or do I use something like mean per unit sampling or difference estimation, one of those, the variable sampling techniques? What would I tend to use for assets? What am I worried about in assets? I want to make sure, I worry about overstatement, so I want to make sure they exist, right? Okay, and they're not overstated. I'm not so worried about completeness. So what do you want to make sure you do? You make sure you pick the big ones. So what would you tend to use? Dollar unit sampling, right? Right? Because you get the big ones. You make sure you do. You automatically stratify. Or I'd stratify and then use mean per unit or something like that. Okay? Variable sampling. Everybody got it? You have read this chapter, right? It is kind of tough, isn't it? There's a lot in here. Okay, so, and what we want to do is make it common sense. Okay, what would I tend to do, 1 second, what would I tend to do if it's a payable? Liabilities. What am I more worried about? Completeness. So what do you want to do? I want to find the ones that are little that should be bigger. I'm not going to use probability proportional to size, dollar unit sampling, right? I don't want just big ones, I want the little ones. I want ones that are 0 and should have been 200,000. You got it? So now what am I going to use? I'm going to make my sampling unit be accounts or invoices or something, right? So everything has equal probability of being selected. Got the idea? I want to look at the ones that might not be complete or look for things that are missing. That make sense, guys? We change our whole emphasis on auditing, okay? All right, we've been talking about that all along, but now it's starting to get real, I hope, okay? Something you can relate to. I'm sorry, comment, question? I went long enough, you lost it, I'm good at that.
The transaction side, so we're looking for
I guess, the number mistakes, and then on the balance side, you're looking for the dollar amount of it.
Yeah. Here would be how many times they did not follow the control. That's an exception, right? Not exceptions, sorry. Deviations are exceptions. Here, the deviation or exception would be they recorded the transaction wrong, right? We still
So you
worry
don't
about
care the dollar.
Well, we still care about the dollar amount because that's going to help us get a good balance. But on the controls, we care too if it affected the dollar amount. Usually they don't, but the transaction would, right? So they're different, okay? So this is using controls to record transactions, but there is a dollar amount. So that's a nice insight. Over here, I care if the balance is right or not. I don't care how it got there. Okay? You can be an adjusting journal entry guy on there, right? We're fine. In fact, if you're in a small client, you know, they're non-public, you're in the small client and they have a whole bunch of mistakes, you know what you do? You propose journal entries, they book them, and you can give them their honest opinion, right? If that happens a whole bunch in a public company, what would you think? If you got a couple hundred journal entries in a public company,
Right.
oh my gosh, it's ugly, right? They got a bunch of CPAs working there, right? And financial vice presidents, you know, I mean, come on, really? What would you think of their control? It's horrible, right? They got a whole bunch of journal entries. They'll have already made the journal entries before you get there, right? If you start finding a whole bunch of them, you're worried because they think they're done, right? What if it's a little tiny company and you're auditing them and they don't have a CPA working for them, right? Awful. You know, you're doing an audit. Not really awful, it's all right. But, you know, they have a bookkeeper that is pretty good, but, you know, you find some adjustments. So what? You know, you're helping them, right? It's okay. As long as you maintain your independence, remember, you propose a journal entry, you do not make one. You're not making any decisions, and they can agree to do it or not, right? Okay? Their journal entry, they have to understand it. Their representations in the financial statements. We beat that to death earlier, didn't we? Right? Well, we beat everything to death. All right, anyway. So define the sampling unit. I guess I beat that to death. All right. Specify a tolerable misstatement instead of a tolerable exception. Make sense? How far? We think the account is properly stated. It's $1 million receivable. If we decide that our scope for materiality on that account is $100,000, boy, that would be nice. Easy audit, right? If you put $100,000 on $1 million account, what range are you willing to live with? When you come up with your independent estimate based on your sample of the population is 1 million on the books. How low could you go and how high could you go if you have a tolerable misstatement of 100,000? 900 to $1 million a month. That's it. It's that simple. Okay? Right? And you'd have it at what? A certain confidence level. Which is what? The confidence level is what? 1 minus what? ARIA, what's that? Acceptable risk of incorrect acceptance. Yeah, we don't want to do that. Right? Okay, sure. That's it. You got it. Okay. I hate those abbreviations because I never remember what they stand for. I wish I just put the words up. I have to think about it every time. I mean, it's not instant. That's a remember. Okay. Select the sample. If this is judgmental, oh man, it could be haphazard. You want to do that? Nah. Use a random number generator for crying out loud. Determine your sample size too, right? Appropriately using statistics. And you don't have to do the statistics yourself. Your computer's going to do it for you, right? It'll work. So, unless it's a little tiny population, I bet you anything that you're going to be using stat sampling to work. Right? It's a real small thing, well, maybe scrap a few of them. Even then, there's not even a reason not to use stat sampling.
So what do we have to know for the exam then?
Oh, for this exam? I think it's going to be a lot of fun. I think you ought to be able to do all the calculations we're going to do today. Right? The whole thing.
So it's not going to be like our other things?
Nah. You guys are doing too well on those. Let's do some problems. In these 2 chapters, we've got some tables we can use, right? And we've got some formulas we can use.
So you want us to know?
I'll give you, what I usually do is I give you a whole bunch of formulas and you have to pick which one you need. Okay? I won't tell you what the formula calculates. I'll just give you the formula and so you jog your memory and you need to know which one's which. That sound all right? We'll do it that way. That's pretty easy. You don't have to memorize formulas. Okay? But be able to use them. Yeah, be able to use them. That'll be good for you. You'll really get these couple of chapters down if you do that. Right? Be able to use the tables from chapter, what are we on, 17? From chapter 15, be able to use the tables. That's all that one was, right? And then here, be able to actually calculate your sample size. Use the tables, calculate your sample size, and then evaluate the results. Okay? be able to do dollar unit sampling and the variables methods. Why not?
Are you
That'd be
gonna give
fun.
us the tables or let us use our books for the tables?
Well, I'll have to give you the tables too. Yeah, I'll give you the tables. Or you can use your book for the tables. I don't care. Maybe I'll let you use your books for either one. I don't care. It'll be all right. Formulas in your book too. You can go find it. Probably you'll be able to do it without the formula after you do a couple of problems. There are some problems at the end of the chapter, by the way, in both chapters, where they calculate this stuff. Let's see. Types of problems you might do. Calculating the upper limit. 1732 is a nice one, right? 1732 is pretty good. Might work through that. 1729 is real nice. That's a good one. Yeah, if you can do those two, you're probably in pretty good shape. Monetary unit sampling, and 32 is, I had it marked. Yeah, they're looking at, yeah, dollar value too. That's dollar value too. Let's do one. Yeah, 1733 is good. Yeah, not bad. I'm working through those. Got some fun with those. If you do any of the problems 1727 through 1736, you're in there, right? So get comfortable. Do one of each type. Make sure you can pull it out. And then do the same thing with chapter 16 using the tables. A little easier in chapter 16. Okay, that's a nice question. All right, anyway, so what we do is we perform the audit procedures. We find all our mistakes, right? And then we extend those mistakes to what? To the population. Just like we did when we were doing test the controls, right? And test the transactions. Okay, and then we analyze the misstatements, of course, decide the acceptability of the population. We got a bigger problem here. What happens if on the test of controls and the test of transactions, you think the controls aren't good? They can fix them, and you can do a whole bunch of substantive tests, right? If it's a private company, you tested the controls because you thought they were good and they turned out not to be good, you're real unhappy because you wasted a bunch of the client's money doing that. May or may not be able to collect the fee, right? Because you shouldn't have tested. And for a public company, you're going to test them anyway, right? But then you have to fix them. But then you don't rely on them. What do you have to do? Future, you're relying on them, not past, right? If they weren't any good, what do you have to do? A bunch of substantive work. Either way, right? You do a lot of substantive work. Okay, anyway. Here, though, if you decide the population is not any good, what do you have to do? Make a journal entry. You don't. You propose the client to do one, right? Okay, so it's a big deal here. What if the client says, no, you're wrong. Your sample was biased. You can pull more of a sample if you want, but what are you probably going to find when you pull a bigger sample? More mistakes. You're going to find the same thing you found. And you can extend to the population, you can be about where you were anyway. Unless you really did get a biased sample somehow. So you're careful taking these samples. Okay. All right. What do you do if you reject it? Take no action until other tests in other audit areas are completed. They talk about doing that, and that's a really good idea. Don't expand your sample until you find out if other things would cover this and maybe it was okay, so you do the rest of your audit. Perform expanded audit tests in specific areas. You could do that, come at it from another angle, basically. Increase the sample sizes is probably a last resort, unless you have reason to believe your sample was biased. Adjust the account balance. You can always do that. But here's the thing. You have risk of incorrect rejection and risk of incorrect acceptance. Which one is more risky? Incorrect acceptance or incorrect rejection? Acceptance because you're accepting a number that's wrong. Well, what if you incorrectly reject? You will make a journal entry. Ask the client to make a journal entry to take the correct balance and make it wrong. Will that still be audit failure? Yes. Right, guys? Only you'll have caused it. But what does the client have to do? If they think the number is right, and you come up with a proposed adjustment, what are they going to say? Whoa, no. What if they think the number is right, or they know it's wrong, and they intentionally misstated it, and you don't find anything. What are they going to say? Nothing. Which one's more dangerous? Incorrect acceptance, right? They're going to catch you on incorrect rejection a lot of times. They'll say, whoa, wait a minute, you're wrong. Let's do something else and find out, because I think my number's right. Okay? So you'll work on it. So you're not apt to get incorrect rejection, but you can get incorrect acceptance either. Easy. They think the number's right. They think it doesn't need to be modified. Or they know it's wrong and they're trying to pull the wool over your eyes. Right? The worst case. Rare, obviously, but the worst case. So if that happens, what do you have? Oh, they won. Right? Okay? And you get incorrect acceptance. So anyway, that's the deal. All right? You can request the client to correct the population, right, which is adjust the account balance. Really, I don't like that. It's really the same thing, right? Okay, and then refuse to give an unqualified opinion. You can do that. What do you do if you think the number's wrong and they will not make a journal entry? Your proposed journal entry, they won't book it. What happens? Qualified opinion. Absolutely. It's material, right? You got to decide. Everything's a negotiation, right? So, and what happens to public companies that have qualified opinion? They're delisted from the stock exchange. That's not happening. So everybody says, oh, it's boring because they always have unqualified opinions. Trust me, there's a lot going on behind that. Because you can always say, no, I'm not giving you a clean opinion. And I mean, all hell breaks loose with no clean opinion. You get fired, right? They maybe get delisted. They try to find another CPA. You know, you imagine what this is like. Just a mess, okay? So we've got a lot of clout, but so do they, of course, right? Negotiation, okay? Negotiation does not mean compromise necessarily. Okay, let's do monetary unit sampling. Also called dollar unit sampling. It used to be called dollar unit sampling, but now we're citizens of the world, so do we call it dollar unit sampling anymore? Oh, well, of course not. It's monetary unit because, you know, there are euros and yens and stuff. Yeah, okay, all right. Anyway, so monetary unit sampling is an innovation in statistical sampling methodology that was developed specifically for use by auditors. What's the other name for this they use interchangeably? Probability proportional to size. That's because the big ones have more probability of being selected as directly proportional. Why is it called monetary unit sampling? Because the sampling unit is $1 or a euro or whatever it is. Okay? Everybody good? Need to know that. That's it. The definition of sampling unit is an individual dollar. The population size is the recorded dollar population. Preliminary judgment of materiality is used to each account instead of tolerable misstatement. Oh, for each account. How far off could each account be before it's a material error? Instead of how far off could the whole population, the whole dollar amount of, in this case, receivables be? See the difference? Okay? And then what's going to happen is we are going to select accounts, of course, right? Still, we're going to select accounts. We are going to use the dollar interval we come up with to decide which accounts I'm going to use in my sample that I'm going to audit, right? That I'm going to do my audit procedure on, okay? What's going to happen then? That account, it represents that portion, in this case of the receivables, that portion of the ending balance, okay? It's representative of that. What if the interval is 100,000 and my account I happen to pick is $10? That $10 represents the whole 100,000 interval. What if my account is $1 million when my interval is only 100,000? Well, now it only represents the million, right? It doesn't represent more because it's bigger. Got the idea? Okay, so the little ones are really important to you too because they represent that whole interval. Okay? Got the idea? Just sort of conceptually got the idea? Right? Okay, intuitively? All right, let's see where it is important. All right, sample size is determined using a statistical formula. Okay, that's it, monetary unit sampling. Although variable sampling, same thing. By the way, they call it variable sampling because it's classical statistical variable sampling. Which is better statistically? Non-statistical? Of course not. Monetary unit or variable sampling? Which fits laws of statistics better? Variable sampling. But I love dollar unit sampling, even though statisticians don't like it as well. Why do I like it? It automatically stratifies my population for me. Right? I like that. But you could use You could use mean per unit sampling, which is a variables sampling technique, or difference estimation, right? Variable sampling technique. You could use those and stratify before you do it and give the same effect that dollar unit sampling would give you. Still get the big ones, right? Okay, all right. A formal decision rule is used, yeah. Sample selection is done using probability proportional size technique, of course. Okay. Auditor generalizes from the sample of the population, sure. Attribute sampling tables are used to calculate the results, okay. Can be converted to dollars. Make an assumption that the percent of misstatements for each item, an assumption about the percent of misstatement for each item misstated, it applies to the whole item, or the whole interval, and determine the misstatement bounds. Okay, so here we go, because we're using the sample. So what is all of this stuff? Here we go, confidence factors for monetary unit sampling design. This is over on page 569. For different risks of incorrect acceptance, we have a ratio of expected to tolerable misstatement. What are we using this thing for? Look on page 569. So here's the first one. The sample size equals the confidence factor divided by what? The tolerable misstatement as a percentage of population value. So what are they saying in this little example on page 569? What factor did they pick up, you guys? What's the confidence factor they want? On the previous page, it says on table 17.5, I would like an allowable risk of incorrect acceptance. And we use incorrect acceptance, not rejection, to do the sample size, because that's the one we're more worried about. I already talked about that, right? Okay, that's the one we're more worried about. Okay? So what's the deal? They said what? 10%? Okay? So I go to 10%, and what do I have? Well, what else do I need? I got a 10% column there, risk of incorrect acceptance. What else do I need?
Ratio of expected.
No, ratio of expected to tolerable misstatement. So what's the expected misstatement? What is that? What's expected here? 15,000? What's the population? See the estimated population misstatement? What's the population? 150,000? I expect I might be off by 15,000. 150,000 is the population, so I think I might be off by 10%. Everybody got it? Okay. So now what do I have? What's the ratio? What's the relationship? 10% compared to 10%, right? Ratio of expected to tolerable misstatement. Got the idea? Okay. So, no, I'm sorry. The tolerable misstatement is 150,000. I said it wrong. Tolerable misstatement is 150. Population is 5 million. Come on, Keith. Population is 5 million. So the tolerable misstatement, they said, is 150. We expect we might be off by 15. So I'm willing to live with 150. I think I might be as bad as 15. By the way, do I like that spread? 10 times as much? Pretty good, huh? Right? The closer they get, the bigger the bigger the sample, right? The further apart they get, the smaller. And you can see what happens is the ratio, we're going to get a larger factor, what? As the ratio of the expected to tolerable gets larger, right? So if you have less and less expected, it's really going to help you. And if you have more and more tolerable, it's really going to help you, both of them, as they're spreading apart. You can see it right there on the table. So 10%, and then a 10% ratio gives me what? 2.77. And what did they do with that? They took 2.77 and then divided it. See the sample size on 569? Took the 2.77 and divided it by 0.03. What's the 0.03? Tolerable misstatement is a percent of the population. What's the tolerable misstatement again? You can live with 150. What's the population size? 5 million. So what percent can we live with being off by? 3%. How much do we expect to be off by? Maybe 15,000 out of 5 million.
Yeah.
That's 0.3%, right? So I can live with 3%, I only expect 0.3%. Got the idea? So what's my sample size going to be? 3 divided into 2.77, and you always round up, as they pointed out there, because you can't take part of an observer or part of an account, right? So you always round up. Okay, so I've got 93. Everybody good? Now let's say instead that I wanted a risk of incorrect acceptance of only 5%. That's my firm policy. And let's say I still had that 10% ratio of expected to tolerable mistake. What would my sample size be? What would it change to? 3.68 divided by 0.03. What is that? Quite a bit bigger, right?
122.
122 instead of 93. These are confirmations of receivables, probably, guys. What do you think? Those of you who've done it. A lot more work, huh? A lot more expensive audit. But less risk for the firm. Less risk of incorrect acceptance. Got it? Okay, let's say instead that we expected maybe we'd have 30,000. The mistake could be off as much as 30,000, right? We expect 30,000. And let's say I still have 150 for my tolerable. Now what do I have? What's the relationship between the tolerable and my expected? If I go to 30 for the expected. Tolerable is 150, what's that? 20%. So now you go down to 20%, what would that happen to your sample size? You have 3.41 at 10%, right guys? Take 3.41 and divide it by 0.03 and what do you get? Again, a bigger sample, right? Got the idea? How these would move? Both of them. So whatever I give you, you just go to the table and find it, huh? Easy? Okay, then practice a little bit. All right, then what do? Now we know I need 93. I put all of the items in order, okay? There's all the stuff in there calculated. This is kind of nice, it's all right. Let's take a look. Somewhere they put all the items in order, didn't they, earlier in the chapter? Well, they do an illustration of it. On page 558, there's all the population items, right? In this case, they have 40 customers, I guess, and it added up to 207, 295. See on page 558, table 17.1. If that were my population and I want to select an interval, those intervals, what would I do? I'd take the 207, 295 and divide it by my sample size of 93, and that would be my interval. Then what I do is I would add up dollars from some random starting point in the population. I wouldn't just start with the first one. I'd take some random starting point in dollars. I'd add up to those dollars, and then I'd take each one where the interval hit it, right? So I'd take my random starting point, add the dollars in my interval to it, right? That's the next one. Add my dollars in the interval to it, and that's the next one. What happens when I get all the way through the population? Because I'm automatically getting the big ones, right? Because, you know, if my interval, what's their interval going to be here? 54,000, 53,763? What if an account's bigger than 54,763? What's going to happen? You will hit it. What if it's double that size? You'll hit it twice. Triple, you'll hit it 3 times. So what are you going to have to do? Of course, you're only going to take it once. By the way, here's how we violate statistics. It's without replacement. We don't put them back in because we don't want to confirm the account twice, right? So that's a violation of statistics right there. So here's what you do, right? Classical statistics. What you do is, if you hit it several times, you start at the beginning of the population again and run through again, right? And you pick up more of them until you get there, right? You just keep going until you get, in this case, get 93. Got the idea? That's what the author was talking about here. Okay, so how did they get the 53,763? They took the $5 million that are in the population and divided by the 93, right? This is your sample size, and you got about 54,000. So I'm going to go down, right, until I get there. And they show on the bottom of page 569 is this chart, so it's the same thing. Okay, summary of the steps that you would do, okay? So now what I'm going to do is go down through my population, select them all, right? Okay, so after I have selected them, well, by the way, what am I going to do when I do it? What am I going to do with them? I select those 93. Did you get the idea from that explanation? You got all the accounts in order, adding up to $5 million, right? You pick a random starting point in terms of dollars, so you add up to that random starting point. Add up accounts until you get there, right? So let's say it's 1,300,000. I add up accounts until I'm at 1,300,000. 5 million is going to be my total. They show it. 5, 6, 7. They show an example of it. Yeah, kinda. Except they don't show all of them. But you're right. They're going to add up. This is the cumulative total, right? So that you add up until you get to what? You pick a random starting point, and then you add up until you get to what? Your random starting point, and then you add until you get to your interval, right? Which is about 54,000 here. And you take that one. And then you go add 54 again, 53, whatever it is, right? And you take that one. And then you add 53 again, and you take that one. Some of them you're going to be selecting numerous times because they're bigger than 54,000, right? Got the idea? Double the size. Okay? And you keep going until you get 93 of them. But you'll have to start over in the population. You got big ones, right? Of course, right? Plus, that you had some random starting point. You start down in the population. You got to have the beginning ones again. Okay? So you get 93. So now I've got my sample. I select all those. I have the client go pull all those, the information on them. So in this case, we do a confirmation. Yes?
Isn't 93 like accounts?
Accounts. 93 accounts.
Okay.
And I'm going to keep going that, what was it, 54,000 about? I'm going to keep going those 54,000 intervals and taking the account that's at that 54,000. It's going to hit the middle of the account somewhere, right? Middle of the dollars, adding the dollars together. I'm going to take that one. Then I'm going to start adding 54 again, right? Adding them up until I get there. Then I'm going to take that one. I'm going to add 54, take that one. And by the time you cycle back through, you probably won't have 93, right? By the time you get through the population. Because some of them you selected more than once, the big ones.
You don't do that.
And you don't want them more than once because you're not going to send two confirmations to the same company, right? Much less 3 or 4 or something, right? So imagine you got one account that's $2 million. You're going to hit it a lot of times, right? You'll be sure to get it though. Any account over $54,000, what's the probability of selecting it? 100%. You see how this automatically stratifies? You automatically get the big ones? Does that do it? So then you start over again and you keep going until you get your 93. Then what do? Select them, send the confirmations to them, right? We talked about in the last chapter. Get the results back from the confirmations, right? And you're looking for exceptions. How many exceptions do you want with delta unit sampling? 0. If you get very many, you're blowing out of the water. And now you might have to go do variable sampling method. You know what? If you expect very many mistakes, what do you want to do? Expect very many not to come back clean. Those confirmations. What do you do, everybody? Use a different sampling method. Use a different statistical method. Now what I'll probably use is mean per unit. But you know what? The sample size will be much larger. I'm going to do far more confirmations. But I'm going to get an estimate of the ending balance of receivables. This is going to tell me I'm wrong. It's not going to tell me what the right answer is. What do you think of that? My auditing procedure, my sampling, doing all these confirmations tell me I'm wrong, but it doesn't tell me what the right answer is. What do you have to do? Find out what the right answer is. A whole bunch more confirmations. Now when are you doing them? The audit's due, right? You're already done. You're tying in these confirmations after you're in, aren't you? Now you're already done, and you don't know what the answer is for receivables. Get the idea here? And the authors talk about that, okay? So we only use dollar unit sampling if we're pretty confident there aren't going to be very many errors. Okay, then what do you do if there are errors? So that is good on page 567. Thank you. They do show it, okay? All right. What do we do then? After we get our sample size, right? What do we do, you guys? Take the sample, do the audit work on it, and then what? You're going to evaluate the result. Okay, so take a look at the bottom of page 570. What if you have no errors? This is the same. This is the table that's on page 570. What if you have no errors, everybody? What do you got? Yeah, it's just basic. It's 0. Well, what are these? Confidence factors. I took a sample. I did not look at everything. I think I could still be off, right? Due to sampling risk, right, guys? Okay. Because the sample's less than the whole population. So let's see it. The risk of incorrect acceptance of 5%, I'd use 3. At 10%, I'd use 2.31. Right? But what if there are misstatements? These factors are getting bigger, aren't they, for each misstatement? Everybody see it? Okay, so you'll have this table, right? And then we go to page 571. Look at the tainting. Okay, in this example, how many did they find? How many errors were there on accounts? They selected 93. How many did they find? 3. Oh, man, that's a lot. That's a lot. I'd rather have 0. Right? But 3 out of 93 is a lot. The more you get, What happens the more you get? Well, what happens to these factors the more you get? With 3, what do we did 10%, right? 3 at 10%, where are we at? 6.69? What if we'd had none? 2.31? We're going to base our estimate on how far off we might be on this, okay, guys? That's what's going on. Okay, and you can see it growing, okay? What have we found 10? Oh, man. That's a mess, isn't it? Disaster. You can see that in a second. But 3 is pretty bad. 3 is pretty bad. It's 3 times as much almost as none. Okay? That I think I might be off by. Just from that. Okay? So what we're doing is we're looking at our tainting. Okay, well, what's this at the top of page 571? Here's the recorded receivable in each case. Okay? And did they change their example on this? We did, didn't they? Turkeys. Okay, they say 6,000. What's 6,000? What's their interval here? Their interval is 6 was how much? 12? What was their interval? Darn it.
No, the interval is 12.
It was 12. Their interval in this one is 12. In our earlier example, what would our interval have been? It was, oh, I don't know why they switched examples. On page 569, 54,000 with 53,763. If they had continued the example, what would you have used over here? That 54, 53,763 would have been our interval, okay? So let's switch gears and we'll use their 12. 12 is the interval. So when you look at the recorded amounts receivable, account receivable on each of these, this is what was on the books, right? All the other ones that you looked at, the other 90 you looked at, what was on the books is what they came back with, right? So they're perfect. So how much error is there in those? 0. Everybody got it? 0 error. Even though some of them were real small and some were real big, right? Accounts? 0 error found. Okay? This is real error found here. What I've got is I have a recorded account receivable of 6,200 and the confirmation came back 6,100. And I determined that indeed the client was wrong, right? It's 6,100. So what I've got is 100 misstatement. Everybody good? And then the same one for all of them. This is 12,910, right? Came back 12,000, it's 910. This one's 8,947. Wow. Came back 2,947, right? And the misstatement is $6,000. Now, why do I think $6,000 is so terrible? Not just that the amount is big. What does this represent? What was our sampling interval? 12. So what does this 6,200 represent? 12. Right? It represents 12, not 6,200. What does the 12,910 represent? 12. So how much of that are we going to extend to other ones? Why does it say NA here for tainting? Tainting is the amount of error. Why does it say NA? Because it doesn't matter. We got it all. It's 910 on that account, right? That's all of it. I don't need to add any to it, right? Because it got the whole interval, right? What about on the first one? It's 100 out of 6,200. 100 divided by 6,200 is what? 0.016, right? Everybody got it? 1.6%, I guess. That one was off by. I think the whole interval's off by that. Not just that account for 6,200. I think that whole 12,000 interval's off by that much. Got it, guys? Okay, and then this next one, what do we have? 2,947 divided by 8,947, right? Whoops, mistake, was 6,000, I'm sorry. 6,000 divided by 8,947, what do you get? 67% off. I don't think just 8,947 is off by that much. I think the whole 12,000 interval is. Well, let me ask you this. What if you selected an account that was $10 and it should have been $2? You're off by 80%, aren't you? 80% of what? 12,000. So that $8 error would be 80% of 12,000 or 9,600 error. Got it? We extend it to the whole thing, okay? Because it represents it. That one item represents that whole interval. Are we there? Common sense, kind of, after you get it. The hard thing with statistics is getting it to the point where it's just, oh, that's intuitive. It's obvious. And once you're there, that's easy. The math is not, right? Okay, so here we go. We're going to put it all together on this thing. It's on the bottom of page 571. Here we go. Here's the recorded amount. These are only the errors, right? Here's the recorded amount. Here's the audit amount. There's the actual misstatement. I'm going to keep that. The tainting was, oh, one thing first. Notice they put them from the largest to the smallest. Okay, largest to the smallest. Okay. We think that gives us the best estimate. Okay, right? Largest to the smallest. So we got 910 difference, and it just gets carried all the way across. Projected misstatement. Okay, from that one. This one was 2,947, right? And that gave us a tainting of 67%. So 67% times the 12,000 interval. I think it's off by 8,052, right? Not 2,947. Got the idea? Okay. And then this one, and we're going to take it on across. This one's 6,200. Was 100 off. 1.6 times 12,000 is 192. So here's my projected misstatement. If I were not taking a sample, if I look at everything, I'd think I was off by 9,154. If I'd taken all the intervals, right? Okay, figured it all out. Okay, now, what's this? Okay, basic precision. If I had found no errors, what would I have for basic precision? What's my interval? 12. How'd they get 36,000 there? They don't show the calculation.
By the 3 that they got in.
Times the 3, right? Okay, so what would that be? Where did they get the 3?
They didn't, because they said they didn't find any misstatements.
Okay, they're using
Percent is
5% if there were no misstatements. And if you have a 5% confidence, if you can switch that on. Okay, they want a 5% risk of incorrect acceptance, right? 95% confidence. Okay, so look at table 17.7. 0 misstatements, 5% is 3, right? So if you found none of these misstatements up here, you would still have your interval of 12,000. I wish they'd have written it down there, right in your book. 12,000 times the 3. That's what this 36 is. Everybody got it? So if there were no errors, you'd still think you might be off by 36,000. But because there were errors, we know we're off by 9,154, or think we are. But then what do? The first one, right, covered the entire interval, so it's 910. What about the second one? We're going to increase we're going to take the change in the confidence factor as we go up. Again, look at the 5% column on table 17.7. With one misstatement, 4.75 minus 3, okay? So 4.75 minus 3 is 1.75. The next one with 2, right, is 6.3 minus 4.75 is 1.55. So we're going to increase these as each error comes along. We think there's more risk, right, more sampling risk. As I find an error, I have more information, okay? So 8,052 times 1.75 is 14. 192 times 1.55 is 298. Add them all up. Okay, here's my adjusted projected misstatement. Add the basic precision. And I think I might be off as much as what? 51,299. This is the upper limit on how much I might be off, I think, at a 5% risk level, risk of incorrect acceptance.
So wait, so why didn't they do the incremental change for the 910? Because it got the whole.
They got the whole thing.
interval?
Yeah, well, no, because it's the first one. I apologize. It's because it's the first one. And you put them in the order of their size, right? It's because it was the first one. Okay? And then the second one, you'll have the first increment. The other way you could calculate these is you could multiply them by 3, and then by the other two factors. You can change the math. You might see it that way sometimes. Okay? You'll still get the same 51,299. Okay? So they just partition the math this way. Anyway, so what does that mean? Is that my journal entry? No. What if that number is less than 150 anyway? What do I say? Well, no, wait a minute. How much was their limit? I'm sorry. I can't remember. They changed What they say is their tolerable mistake. On this one is how much?
Is that the 12,000?
No, that 36 is basic precision. I don't know why they switched their example.
Tolerable misstatement.
Tolerable misstatement, yeah. 12 million, 1,000,002 is the population, 100 was the sample, 12,000, where did they give us one? Darn it.
I think they did that example differently.
And they use different numbers for their examples. You see the tolerable misstatement there, you guys? Oh, jeez. Okay, well, let's just talk about it in general. What do you think? When would you say this population is correctly stated? It's 1,200,000 population, right? When would you say the population is okay? If your tolerable misstatement is what? Is bigger than that. You got it. If it's that big or bigger, right, you're within it. So in other words, what would he say? If I'm willing to live with being off by 51,299, because that's the maximum I think I might be off by, right? At a 5% risk of incorrect acceptance, what would we say? Population's fine, I will not make an adjustment of any kind. So let's say you're willing to live with 100,000 off. The 1,000,002 could be off by 100, and that's your tolerable misstatement. What would you say? Everything's good. I'm done. I'm thrilled. Okay?
It's less than that.
What if it's less? What if we're only willing to live with 50,000? Anything less, a penny less than 51,299, I'm willing to live with, right? So let's say it's 50,000, right? And I find 51,299 I might be off by. What do I say? Reject the population. Do I know what the population really should be? Will I make a journal entry for 51,299? No. Because it's probably not the right number. It's probably too big. So what do I do? Sample some more and switch to mean per unit. Right? Very expensive item. Could I keep these, how many did they have in their sample? Could I keep these 100 and just increase the sample? Statistics would say that's terrible. You know what accountants would say? Yes, I'm going to keep it and I'm going to use it as part of my estimation. Okay? But I'm going to switch to the other methods, okay? A variables method. All right, everybody good with that? I wish they had switched on me, but they did. Okay, so here they're showing how they got their increments. Pretty easy, it's just the difference. Right? We already talked about that. All right. So determine sample size with monetary unit, materiality, assumption of the average percent of misstatement, we did that. Acceptable risk of incorrect acceptance, recorded population value. Okay. All right. Estimate the population exception rate, relation to the audit risk model to the sample size. What would it be? What is this? Plan detection risk equals what? Acceptable audit risk divided by inherent risk times control risk. Well, you could take inherent risk times control risk times, right, the detection risk, and what would you have? Acceptable audit risk. Okay. Advantages of monetary sampling, well, increases the likelihood of getting the big ones, reduces the cost. Why? Much smaller samples, a lot of times. Easy to apply, right? Gives a statistical conclusion. Okay, so here we go. There we are. All right, this is fun too. It just gets better and better. Okay, this is towards the end of the chapter. We're back at 573, I guess, 574. All right, frequency of values in percent. You guys know about the normal curve, right? That one doesn't look normal, flat. The normal curve on page 574, right? This is assuming a normal distribution. What do we know if it's a normal distribution? One standard deviation, two standard deviations. How many are within plus or minus one standard deviation? You remember that from 68%, right? Two standard deviations. 95. Three standard deviations, 99. Real nice rule of thumb. Okay, if you got a normally distributed population, you got 68% of them within plus or minus one standard deviation. And we're going to be talking about standard deviations. Okay. So, calculated sampling distribution from a population with a known and a standard deviation, a known mean and a standard deviation. what you do is can you get a known mean on a book value of a population? I've got 1,000 accounts. They total $1 million. You guys know how to divide 1 million by 1,000 accounts? You get your mean, don't you? Right? That's the mean of the population. You're going to get a different mean for your sample maybe, but you know what your expected mean is, right? That's what it is. What about standard deviation? Could you calculate a standard deviation on it? Sure, you know what all the different values are. You could calculate a standard deviation on the population, and you could calculate a standard deviation that you got last time when you did the audit, right, on your sample. You can do both. Okay? So that's all they're talking about, right? So they come up with an estimate, right, of the standard deviation and an estimate of the mean. Okay, over on page 576, take a look at that. Okay, what are we going to do? Difference estimation, ratio estimation, or mean per unit? Which one do you think is going to give you the best estimate in most situations of a value? Where you don't know anything about the population. You don't know anything about what could be wrong with the accounts. What would you use? Mean per unit, not difference, mean per unit. Mean per unit. I get an estimate of what each one is on average, and I take it times the total. I know there are 1,000 accounts, right? I get an estimate of what I think the mean is for each account, and I take it times 1,000, and I've got my estimate of the population. If I know nothing about what's wrong with the population, this would be a good estimator, right? It'd be good. So I use mean per unit. When would you use difference or ratio? Difference is when I think each account might be off by the same amount. For some reason, my computer deducted some dollar amount from each one, and I don't know what the dollar amount is. But I think they're all off by exactly the same amount, no matter how big the account is. That I use difference for. I expect each account to be off by about the same amount. So I figure out how much each account's off by, take that amount times the number of accounts I have, and that's how much I'm going to adjust the population for. Okay? Make sense? What would what would ratio estimation do? I think each account is off by about the same percent. So if I think each account is off, I estimate this using my sample, right? If I find out that each account is off by 1%, $1 million account, what would I adjust it by? 1% of $1 million. $100,000 account, what would I adjust it by? 1% of $100,000. How about $1,000 account? 1% of 1,000. Got the idea? So they're different, right? But when would you know you were going to use those two methods? When you have a reason to believe the errors are the same on each account, right? Or when you have a reason to believe the errors are the same percentage on each account instead of the same dollar amount. Got it? Difference is, I think the dollar amount is off by exactly the same amount, right? And ratio is, I think the percentage error is going to be the same across all of them. When would you use mean per unit? When you don't have that information. Because you just get the best estimate you can for each account times the number of accounts. Got it? What the mean account is. Okay, anyway. So we talked about the 6895. It's 99.7. I always say 99. Okay. So over on page 578. Oh, what if it's skewed, you guys, the population? You need a bigger sample. Because you need more information from your sample. So that's about. Okay, we talked about these three methods. All right. Stratified statistical methods. All the elements of the population are divided into two or more subpopulations. Each subpopulation is independently tested. Let's say I have this. I have 1,000 customers, but 3 of those customers make up 60% of my receivables. You know what I'm going to do? I'm going to do those 3. And I've got 60% already. Then what am I going to do with the other 997 customers? Take a valid, statistically random sample from those. Right? But I'm going to make sure I get the 3 big ones because they have 60% of my receivables already. And the rest of the work I'm doing is to get 40. And I can have a smaller sample. Got it? Okay. So we divide them into subpopulations, each one independent. Calculations are made for each and add them up. Okay, good. All right, this is really important at the bottom of page 578. What could go wrong? By the way, do you know the actual state of your sample? Do you know what happened of your sample? Yes. I know what my sample results are. I have them. Do you know what the actual status of the population? Of course not. That's why you're taking the sample and auditing. So this is hypothetical, right? But it's what could happen to you. All right, so acceptable risk of incorrect acceptance and acceptable risk of incorrect rejection. So what happens? They give you, they like to give you lots of multiple choice questions on this. I really like the table better, in the book better than that. Let's use the table in the book. That's awful. Okay. If the actual audit decision is conclude that the population is materially misstated, that's what you do. So you reject it, and you have them make a journal entry, right? What happens if it really was materially misstated, and you find out you think it's materially misstated, and you have them make a journal entry to fix it? What do you think? That's the correct conclusion. Of course, it's great. What if, though, you conclude it's materially misstated, and you convince them to book the journal entry, and now they are materially misstated? What do you get? Incorrect conclusion, risk of incorrect rejection, right? That's incorrect rejection. Just know the difference. Okay, let's go down the line. Conclude that the population is not materially misstated, but really it was. What do you have? Incorrect conclusion. This is really audit failure. What did I suggest would happen if you conclude it's materially misstated and the client is just really sure it's not? They'll ask you to do some more work, and you may be able to avoid the risk of incorrect rejection. You guys staying with me on that? I said it over and over now, a couple times at least. Okay? So that was riskier, isn't it? The risk of incorrect acceptance is riskier. Incorrect rejection, they'll probably stop you or try to stop you. Okay? You still have it. You could take a good number and make it wrong. How's audit failure? Okay, but for sure, the risk of incorrect acceptance is going to lead, if you have incorrect acceptance, you're going to have audit failure. Okay, what if we conclude it's not materially misstated and it really is not materially misstated? Yay, you're okay, correct conclusion. So we got that. Okay, good. All right, let's try difference estimation. Difference is kind of handy. Apply in the sample, calculate sample size, state the objectives of the test. Is the account properly stated or not? Whether the audit sampling applies, yeah, sure. Misstatement conditions, it's off. Define the population, it's the receivables. Sampling unit is going to be what? Accounts now. For any of these methods, it's going to be by account in the case of receivables, okay? Or by invoice or something, okay? And then how much tolerable misstatement? What's the tolerable misstatement going to be based on? Total population, okay? Identify your risks, and this time we need both, okay? And then estimated expected point estimate, what's that? That's the mean. Make an advanced population standard deviation estimate, the variability of the population. Okay, so we're now going to do sample sizes. Calculate the initial sample size. Oh my gosh. Where is this? On the bottom of page 579. So N is the sample size, right? What's this thing? Standard deviation times, what's this? Confidence coefficient for incorrect acceptance from the table in 1712, right? Plus, what's this one? The confidence coefficient for acceptable risk of incorrect rejection. What's in? That's the total population size, right? So this would be all your accounts, right? This is going to be the size of your sample over here. What's TM? Tolerable misstatement. What's E? Expected misstatement. Got it? That's the expected misstatement. Okay. So look at their example on page 579. They show their advanced estimate of the standard deviation, right? And then their population size was 4,000. Got it? Tolerable misstatement 21. Expected misstatement 1,500. Okay, so they get 9.97 squared, and they get 100. Okay, auditor must use one of the probabilistic sample selection methods, random number generator maybe, right? Okay, the auditor must use care in confirming and performing alternative procedures, of course. So what we're going to do is compute the point estimate of the total misstatement, compute an estimate of the population standard deviation. So now we have our original estimate, and now based on our sample, we get a new estimate. Got it? Compute the precision interval that we want, and our confidence limits. Okay. They stopped on me. I didn't think it was all there. On page 580. Okay? They took a random sample, 100 accounts receivable selected randomly, right? Okay? And they took them out of 4,000 accounts, that's fine. Determine the value of each misstatement. How would you do that? For each one of the items, you confirm it. And what's the misstatement on most of them? What do you hope for? 0. But you know what? If you thought they were all going to be 0, what method of sampling would you use? What statistical method would you use? Dollar unit sampling. So here you expect something, right? Okay, but you want to get an estimate of what the receivables really are in this case, right? What the account balance really is. So I've got each one of them, and they show how much they were off by, understatements and overstatements, and then they add them all up. Got the idea? Compute the point estimate of the total misstatement. What are they doing here? Take the sum and divide it by what? The number of accounts that you audited, right? You did 100 of them. Not just the ones you had mistakes on. You don't care what the average mistake is. You care what the average mistake is across all the accounts. And the other accounts, the other 94 of them, because you did 100, right? This is 6 with mistakes. The other 94 were perfect, so you get to include those. So you think the average account is off by how much? 226, okay? Compute the population standard deviation of the sample. What do we have here? We've got the value of what? And what's the 228? And the 45, 124? The 228 is how much you're off by, right? Okay. What's the 224? The 45? Squared? The deviation, right? Okay. So calculate the standard deviation of them, okay, based on the sample. So you get a different standard deviation for the sample, and I'll probably just give you that. I will not guess. I won't make you calculate it. What did they expect their standard deviation to be? 20. What did they get? 21. What do you think? I'd like it to be less. Certainly not any more. If it's bigger, there's more deviation than you expected, right? More what do you mean by standard deviation? How far is from the mean, right? But is it really exactly how far it is away from the mean? That'd be variance, wouldn't it? What's this? Squared, right? Okay, so it's standardized. It's rid of the negative. Okay, compute the precision interval. What's this? What's this thing going to be in step 5? The precision interval tells me what? How far off I might be, right? Okay, and then compute the confidence limits on the thing. What would I do? Take my error plus or minus my precision interval. So I might be off by as much as, okay? So they run through that. They didn't show, geez. They didn't even show us mean per unit. I guess I'm not testing you on that. What would you do on mean per unit? Exactly the same thing. You get the mean, and what the other one is the ratio estimation. Same thing, right? It's the same basic idea. I really don't like this off. I didn't realize I didn't do both of them at all. What do we do with that? Same sort of a calculation. You're going to get a confidence interval. And what do you want to make sure of with the confidence interval? You take your population, right, and you add and subtract the confidence interval. And then what do you want to make sure of? Your new value is within your tolerable error. That's it, okay? If it's not, what do you do? If you get outside, what do you do versus if you stay inside? If the recorded book value of the population is within that confidence interval, 95% confidence interval or 90% confidence interval, if you're inside there, what do? The accountant's fine, you do not adjust it. So what if I'm only $1 within? It's fine. I don't change it at all. This is statistics we're doing. What if I'm outside? So let's say my confidence interval is plus or minus 100,000, right? And I'm off by $99,999 plus or minus. What do? I leave the account alone. I don't change anything. I keep their book value, their estimate. What if it's $100,001? I'm just outside. What do? Make a journal entry for the $100,001. You don't just make it for $1 to get back inside. That doesn't work. So it's all or nothing. Statistics is bizarre, you guys. And I apologize for that. I apologize to the office. They really dumped it there. That's sad. Is there an appendix here that has it? Nope. Okay. By the way, is that going to be a problem for the CPA exam? I just want to get more. All I can do is difference. Yeah, I'll just give you a difference. I'll give you the estimated, and then I'll probably calculate it for you. Yeah, that's what it is. Maybe you use it.
Is this on the CPA exam?
The theory is yes. The concepts are yes. Calculating them, highly unlikely. Highly unlikely. So would I memorize the formulas for the CPA exam? No. But cranking through them and understanding how it works, yes. They'll ask you, what happens to sample size if you do this or this? What happens to the sample size if or what happens to your estimate of the error if you have a larger sample standard deviation than expected deviation, right? And what it's gonna do is gonna make the error larger, right? You found the problem. That's all it is.
Keith, I have a question.
Yes.
For the monetary units, can you